Mistakes when investing can lose you thousands of pounds, and whilst learning from these mishaps is great for development, it might not be great for your pocket. So why not avoid making these mistakes in the first place? Hey everyone, and welcome to The Savvy Squaddy. In this video I'm going to go through 5 common mistakes people make when investing. If you're new to the investing world or soon to start, then this will be of great benefit. I and many others have fallen foul to some, if not all of these mistakes at some point and have lost money. So let's get straight into it with mistake number 1, and that is investing before you are ready. Now I'm going to mention 3 different aspects of not being ready which can apply: financial stability, lack of understanding, and no clear financial plan or goals. If you fall short in just one of these aspects, I would say you are investing before you are ready. So, financial stability. Investing is long term and it carries some amount of risk. If you jump into it with financial issues elsewhere in your life, you could open yourself up to greater damage. Before you begin investing, ideally you should have a suitable emergency fund saved up. This is around 6 months worth of living expenses to protect you and your family should something big and unexpected happen. Having this will prevent you from having to sell part or all of your investments to fund any unforeseen large expenses that might pop up. Debt. If you have high interest debt, then you should not be investing. The interest on that debt will more than likely be more than the returns you would get on your investments. The money you want to invest will be better put to use paying off that debt instead. And then, once paid off, avoid going back into it. If the only way to fund car repairs, a new fridge, a vet bill, and so on is either to go in debt or sell some of your investments, then you have started investing too early. You are not financially stable or secure. You'll end up selling part of your investments, potentially at a loss, to pay for those unexpected expenses, which will do long-term damage to the growth of your investment portfolio. If you happen to sell at a profit to fund these expenses, then you start to get into the realm of having to pay capital gains tax. Also, investing before you are financially stable can lead to unnecessary stress and anxiety. If you are not in a position to absorb potential losses, you may find yourself constantly worrying about your investments, which can negatively impact your overall well-being. The best way to avoid this is to only invest what you can afford to lose. It would be an absolute kick in the teeth if my own investment portfolio went to zero. I would of course be pretty pissed. But despite this, my family would still be able to continue living as if nothing had happened because we are financially stable and secure, as I've only invested money that we can afford to lose. Might not like losing it, I mean who would, but the point here is that by only investing what you can afford to lose, you're protecting yourself and your loved ones from financial distress. Whilst it's never pleasant to see your investments take a hit, knowing that it won't jeopardize your family's well-being brings peace of mind. Remember, investing should enhance your financial situation, not put it at risk. Also, as a general rule of thumb, if you need the money in less than 5 years, then it is best to put it in a high interest savings account. You should not be investing money that you will need soon, as the stock market can be quite volatile and the value could go down. Investing is for long-term growth, but this is where having a financial plan and goals helps out, but more on that in a bit. Another aspect of investing too early is not understanding what you are even investing in. All too often people rush in because they don't want FOMO, fear of missing out, but because they haven't done any research or due diligence, they often lose money. A lack of knowledge can lead to poor decision making, resulting in financial losses and missed opportunities. Understanding the basics of investing is pretty important, as is knowing the different types of investment vehicles and the risks associated with each. By being informed, you can make better decisions, manage risk more effectively, and work towards achieving your financial goals. The best solution here is to simply take some time and learn about these topics. The time taken now to gain a proper understanding could both save and make you a lot more money than if you just go in blindly. I have a whole playlist filled with videos on investing. I will link it below. Check it out as I expand on many of these aspects. To effectively understand an individual company can take days, if not weeks of research, and if you have a full-time job, time is limited, which is why short-term trading in and out of stocks does not work for the majority of people. Check out this podcast episode where Sasha breaks down how much time he spends analysing the companies he invests in. Most of us don't have that amount of free time to spare, which is why, for most people, investing in index funds is the easiest solution. If you have not understood some of the terms and phrases I've used over the last few minutes, then you are lacking in some investment knowledge and therefore it's probably too early for you to be invested. Take some time, do some research so you are able to make more informed decisions that reduces the chances of you losing money. And the final aspect of investing too early is when people don't have any clear financial plans or goals. Without a plan to stick to, you are more likely to make decisions which might not be the best thing for the long-term growth of your portfolio. The goal could be simply a pot of money as a source of extra income in retirement. It could be giving your children some financial stability when they turn 18 by investing into a junior ISA for them. It could be to retire early. There are so many potential goals, but it's important to have them. Financial goals and plans give clarity and focus. They motivate you to stay disciplined with your finances. You are able to tailor your investment strategy to match your risk tolerance and time horizon. They allow you to measure your progress and see how far you have come. And they also give you some peace of mind as it gives you that confidence that you are taking the right steps to secure your financial future. Jumping into investments without a plan or any goals could do more harm than good. Take the short amount of time required to actually set your direction of travel. Right, those three aspects were all part of the first mistake. Next up, the second mistake, and that is simply delaying investing altogether. Not investing at all or taking your sweet ass time to do it can be a costly mistake. After the last couple of years, I'm sure you are all aware of something called inflation. If you're not, then check out my video on it. Keeping all of your money in a savings account will see it lose its purchasing power as inflation erodes it. Investing is one of the surefire ways to earn returns greater than inflation over the long term. Another reason not to delay investing is because of the power of compounding. The longer you are invested in, the better, and naturally someone starting at the age of 25 will benefit more than someone starting at the age of 55. As a quick example, Joe invests £200 a month at the age of 25 into an index fund for 40 years. The average annual return is 7%. Jane also invests £200 a month, but she is 45 and she invests for 20 years and also receives a 7% average annual return. At the age of 65, Joe will nearly have £525,000 in his investment pot. Jane, on the other hand, starting a bit later on in her life, will have nearly £105,000. Joe will have an investment pot 5 times the size of Jane's, whilst actually only contributing double the amount she did. And that is the power of compounding. That is why you should be investing, and for the long term. Just as an extra point, Joe's investment pot would bring in an annual return of just over £35,000, providing a 7% return could be maintained. That's a great secondary source of retirement income in later life. So, moral of that story, don't wait too long to do it, you will miss out. A third mistake, which is very common, is trying to time the market. Buying in at the very low and selling at the very top, locking in them fat profits. However, if this was such a simple thing to do, then everyone would be doing it and would be very successful. The reality is it's almost near impossible to predict the short-term fluctuations of the stock market. Prices fluctuate due to the collective buying and selling decisions of investors, which are influenced by various factors such as supply and demand, economic indicators, investor sentiment, company performance, global events, and market trends. Timing the market is often ineffective as it is difficult to predict future market movements consistently. There are people whose full-time job it is to try and predict what is going to happen and make money from it, and even then most of them struggle to beat an index fund that tracks the market. Honestly, ask yourself, what hope do you think you have? As an average investor, be realistic about your own limitations in terms of time, resources, and expertise. Instead of attempting to predict market movements, more effective and consistent approach is to invest in a low-cost index fund and maintain a long-term perspective. I've made a whole video on this topic where I also share an example to illustrate how just by buying consistently over a long period of time beats out timing the market, even when that person had perfect timing, which is unlikely. Check it out, it is linked below. Mistake number 4 is allowing those pesky emotions to take control of your investment decisions. Now, there is a time and place for emotions, stepping on a piece of Lego, getting woken up for stag, but keep them in check when it comes to investing. The stock market is a volatile place. It goes up and it comes down, but long term the trend is up. Emotions can lead to irrational decisions that may not be in your best financial interest, because when crashes do happen, and they do, you are able to keep a level head and not make any irrational decisions which could negatively impact your investments. It doesn't need to be a crash either. Maybe you see a certain stock rising every day and you get all excited and buy in because of FOMO. You do so without doing any research into that company or any understanding of why it might be on the upward trend. You buy in at all-time highs. Then it comes back down not long after, leaving you in the red for the foreseeable, permanently if you sell. Again, Understand what you are investing in, stick to a well thought out investment strategy and keep those emotions in check. And finally, the last mistake on this list is chasing hype and trends. Basically, this isn't the smartest move. Overhyped and trendy investments are often built on shaky ground, driven by short-term excitement, and can be super volatile. When you chase hype, you might end up making decisions based on emotions instead of logic, which can lead to impulsive choices that don't match your goals or risk tolerance. Plus, the fear of missing out can make you take on even more risk. You can see many of these mistakes all tie in together. Some recent examples would be the SPAC attack in the electric vehicle market in 2021, most of which have come crashing down since all-time highs. The whole fiasco with GameStop is another example. There's a documentary on Netflix if you want to learn more, but many people hopped into that stock because it was trendy. That too came back down to reality and many people lost money. Again, because of a lack of understanding, reacting emotionally and chasing trends. More often than not, by the time you hear about it, it's too late. You'll end up buying in at the top, and those that were early will start selling and locking in their profits. So, rather than chasing hype and trends, do your research, think about your risk tolerance, and build a well-diversified investment strategy that is based on sound principles and long-term goals. This approach is more likely to give you those stable returns and help you achieve your financial plan. And that's it. Those are 5 mistakes that people make when it comes to investing. Mistakes are part of the journey, but some are avoidable. Instead of learning the hard way through trial and error, why not take heed from those of us who have already been down that road? So, we've covered a lot, from investing before you're financially ready, to understanding what you're investing in, and even having a solid financial plan. These elements are pretty important because they provide clarity, reduce stress, and keep your investments on track. Remember, investing should enhance your financial situation, not put it at risk. If you're unsure, take the time to educate yourself. Knowledge is power, and it can save you from costly mistakes. Investing should be boring. It's not very exciting at all. Don't let emotions dictate your decisions, don't chase hype and trends blindly, and certainly don't try and time the market. It's a losing game. So, take a deep breath, stay informed, and stick to your plan. Investing is a journey, and by avoiding these common pitfalls, you're already ahead of the curve. Have you made one of these mistakes? What are some other things people should be aware of? Let me know down below. Thank you all for watching. If you liked what you just saw, please hit the subscribe button up there, and if you want to see some more videos, click over there. See you soon.